Let's talk about the Ivy League endowments have dismal returns because of private equity. We continue to talk about it because I know people still have in the portfolio, but I was very concerned when I saw the Ivy League schools, who, again, I thought were the smartest people in the room, began investing in private equity a few years ago. Well, gotta tell you, the results are in, and the returns, I'm not gonna sugarcoat it, they were terrible. The best annual return goes to Cornell, and for 4 years, from 2022 to 2025, or for the years 2022 to 2025, they only had an annual return of 5.7%, and that was closely followed by Harvard at only 5.5%. And Chase, I think you got the bottom of the rack of what they did.
Yeah, worst performer, poor Princeton here, only had an annualized return of 2.8% over that time period. And a large reason, I got to say it, for these low returns is that, as you said, the managers of these endowment funds invested heavily in private equity, as the category made up as much as 40% or more of the portfolios for schools such as Harvard, Yale, and Princeton. And the other thing I want to say to that is the returns might get even worse in the coming years because, as we said before, with private equity, private credit, it's not a real market price on an annual basis. So the fact that the returns were this poor with having that much private assets, it's a problem.
Well, and also, too, we're now starting to see some pressure on them. Was it BlackRock on Friday announced closing the fund? Or
Not closing. They're limiting the
limiting.
withdrawals. And
Right.
I love the way that they sell this. They say that the reason that, I mean, I guess it kind of makes sense to a certain extent, but this is why I just don't like private investments. They say that the reason they limit these fund withdrawals is so there's not a big mismatch and they aren't forced to liquidate positions at a bad time, costing the other shareholders. Which is true, but again, just don't buy something that you can't trade or get out of if you need the money, because that's where we're now seeing the problem of limiting withdrawals, and you want out. Sorry, to help the other people in the fund, you can't have your money.
And I think all that does, and they're correct what they say, but all that does is create more selling pressure because then, well, now I can't get out. As soon as I can get out, more people say I'll get out. And then I think it starts cascading downward. More people just getting out, and it's virtually over. But people got to wait some time to get their money out.
Well, especially with the headlines. I mean, BlackRock in particular wrote down a second private loan. Now, it wasn't a huge loan. It looks like it was a $25 million second lien loan. I mean, we're talking about a fund that's billions of dollars, but it nonetheless is showing that there's some issues occurring in the private credit space. Just 3 months ago, this loan was valued at 100 cents on the dollar. Well, I think it was Tuesday, $0. No, it doesn't go from last month to 75, then 25,
Right to
then
zero.
0. It goes from 100 to 0. And that's the big problem with this private space is you can think everything's fine until the moment they write something down to 0, and it's like, what happened? Oh, well, yeah, it's worthless.
Wow. Well, the endowment funds have tried to liquidate as much as they can, but the secondary market, as we're talking about, has been rather weak. And Yale and Harvard were only able to liquidate about $1 billion of their private equity holdings last year. I think we're only in the second or third inning of how bad things will get with private equity, private debt, these deals that were just done, and they were great when everything's going up. But now that what did Warren Buffett used to say, that when the tide goes out, you say, who's not wearing a bathing suit?
Yeah, or the king has no robe, or I forget the situation with the king.
I think
but
Warren Buffett was.
yeah, he said something about the king not having a robe.
Oh, I think the king, I don't know if he did that one, but the one with the king was where that the king is walking down naked and nobody says anything until this little boy goes, he has no clothes on.
But looking at this private space again, unfortunately, many people, including foundations, will have poor performance and probably even some losses. Again, going from 100 to 0, that's a loss of capital. That's not even a volatile asset. We always talk about the difference between volatility and risk. That's just pure risk to lose 100% of your money. And I'm going to say a day because you thought you had money and then all of a sudden it's gone. A lesson to all investors: don't get sucked into a hype investment of any type, as eventually the hype disappears and you end up with nothing but dismal returns or losses. And I just really think the big problem here, again, is all of these negative headlines. It's causing people to want to get out of these assets. And I think it's going to create situations where you're going to have a long list of people that now don't want to get into these assets because they're like, you can't get out and the performance is bad. Well, I don't want to get in. And it could create a cascade or a downfall for this private placement market.
Yeah, what's that called? The big snowball comes down the hill. Avalanche? No.
I think it's avalanche. Yeah.
Yeah. And that's going to happen.
I mean, the concept with the snowball is it rolls down, it
Rolls.
gets bigger and bigger and bigger as it rolls down the
It gets
hill.
worse and worse. But I think who's going to win from this is going to be the attorneys, because there's going to be so many lawsuits and people losing money and suing here, suing that person, suing that person. And again, if you're in these private equity funds, first of all, if you're not in them, do not go into them. And if you are in them, try to get out first, because that door of getting out is getting smaller and smaller and
I
smaller.
mean, we've talked about this before, but we have clients that come over to us and they have interval funds. Again, we've talked about that a lot. Don't do that. Interval funds and these alternative investments, and they've been with us now for 5 years, and we're still not out, because every single quarter we can only get 5% of what's available on that particular investment, and it's just, you're stuck in it for a long, long time. And some of the returns have just been awful for the positions that we're in. And the fees on some of them, like 3%. You're just like, wow, that's great for you. You don't have to pay out, more than 5% of the assets. You get to collect a 3% fee. And also you get to collect a higher fee off of an illiquid asset that you get to determine the market price. Talk about a winner there. It's these alternative asset managers.
Yeah. And again, Wall Street's always great about coming up with ways to make money off of you, and they always fail. I mean, we talk about it. So I've been on the Smart Investing Show for 35 years now, and just buy good quality equities, watch the fundamentals, you'll do fine. But Wall Street, forget that market fluctuation, stocks are too risky, and they come up with this. So